Okay, let's get right into it. Today, we're diving into a highly critical procedure that every auditor, cost accountant, and company secretary absolutely must know to the letter. Welcome to This Explainer, where we're taking a focused, deep dive into the bedrock of financial accountability, your statutory duty to report corporate fraud under the Companies Act 2013. Because look, when you're going through the books and you spot something that just doesn't add up, the law doesn't just ask you to politely raise a hand. It literally hands you a stopwatch and a very specific set of instructions. Picture this for a second. You're sitting at your desk, maybe it's late on a Friday afternoon, right? You're reviewing a series of transactions, and suddenly, click, the pieces fall into place. You find undeniable evidence of corporate fraud being committed against the company by its own officers. Well, from the precise second you realize what you're looking at, the clock starts kicking. Your next moves are strictly dictated by law. You can't just casually email the CEO or, wait until the next quarterly meeting to bring it up. You are now bound by Section 143.12. And honestly, every single action you take from this moment onward has massive legal and financial implications, not just for the company, but for you. So here is our roadmap for today. Spotting corporate fraud, the one core threshold, the ticking clock, penalties for staying silent, and finally, audit committee and other duties. Let's kick things off with Section 1, Spotting Corporate Fraud, the trigger. Now, a really crucial point to remember here is that this mandate doesn't just apply to your traditional statutory auditors. The law makes it abundantly clear. This heavy responsibility also explicitly covers cost accountants conducting audits under Section 148 and practicing company secretaries doing secretarial audits under Section 204. So, if you're in any of these roles, and during your duties you have reason to believe that a fraud is being or has been committed against the company by its own people, you have a statutory duty to act. You are basically the frontline vanguard protecting the stakeholders here. Moving right along to Section 2, the one crore threshold and the diverging path. The law actually forces you down one of two very different reporting paths, and it's based entirely on the size of the fraud. It's a literal fork in the road. If the fraud involves individually an amount of rupees 1 crore or above, the law treats it as a matter of massive public interest. It instantly escalates to a central government matter. But on the flip side, if the fraud is for an amount less than 1 crore, it stays internal. In that case, you're required to report it to the audit committee or the board of directors. Let's look a little closer at that internal path for a second. Even if the fraud is below that 1 crore threshold, the law absolutely does not give you the luxury of time. You have to act fast. You are required to report this to the board or audit committee immediately and no later than 2 days of your knowledge of the fraud. 48 hours, that's it. And you can't just send a vague, hey, something's wrong warning. You have to give them 3 specific things: the exact nature of the fraud with a description, the approximate amount of money involved, and the identities of the parties involved. All right, on to Section 3, the ticking clock, focusing on the central government procedure. This perfectly illustrates those relentless deadlines I was talking about. If the fraud hits that 1 crore mark or above, you don't just speed dial the government. There's a very precise 3-step dance you have to do. First, just like with the smaller frauds, you get that rapid 2-day window to report the matter to the board or audit committee. But this time, you are specifically seeking their reply or observations. Second, you enter a strict 45-day waiting period. This gives leadership a chance to investigate and give you their official stance. And finally, once you get their reply, you have a tight 15-day window to bundle the whole shebang, your initial report, their reply, and your own comments on the reply, and dispatch it straight to the central government. But what if they just ignore you? What if the board tries to sweep it under the rug and you hear absolute crickets? Well, the law saw that coming. You cannot let the board's silence stop the clock. If that 45-day window completely closes and you've heard nothing, your duty does not disappear. You are legally required to push the matter up to the central government anyway. You just forward your original report and you attach a very specific note detailing the board's failure to respond to you. You have to keep the process moving. And when it is time to actually send that report to the central government, you can't just fire off a quick email. The law demands exact physical formatting. You absolutely must use the prescribed Form ADT-4. It has to be printed on your official letterhead, complete with your postal and email addresses. You have to stamp it with your professional seal and include your membership number. Then it gets placed in a sealed cover and mailed to the Secretary, Ministry of Corporate Affairs using either registered post with acknowledgement due or speed post. And finally, just to bridge the physical and digital gap, you have to follow up that mailed package with a confirmation email to the ministry. It's an airtight, incredibly rigorous process. Okay, Section 4, penalties for staying silent. What are the actual stakes here? Ignoring your duty to report will cost you dearly, as you can see in these financial penalties laid out in Section 143.15 for auditors, cost accountants, and company secretaries. The law takes the protection of public investors in listed companies extremely seriously. If you fail to comply with your reporting duties for a listed company, the penalty is huge. Even for unlisted companies, the fine is substantial. It's designed to be a massive deterrent against turning a blind eye. That's 500,000 rupees, 5 lakhs. That is the unavoidable fine waiting for you if you look the other way on a listed company fraud. As per Section 143.15, if you fail to comply with the provisions of subsection 12, you will be liable to pay this exact penalty out of pocket for a listed company, or 1 lakh for any other company. The stakes for your professional and financial life, they are literally written into the statute. Finally, Section 5, Audit Committee and other duties, looking through the wider lens. Because look, you aren't just a silent observer who only speaks up when a crime happens. According to Section 177.5, the Audit Committee has the power to call upon your specific expertise. When they ask for your comments on the internal control systems, the scope of your audit, or your review of the financial statements, you are legally obligated to provide that insight. You are a crucial advisor for their oversight functions. And beyond fraud and internal controls, your signature carries the ultimate weight. Under Section 26, if a company is issuing new shares and publishing a prospectus, you have a duty to report on the accounts included in that document to protect future investors. And under Section 145, you must formally sign off on the audit report itself. That signature is your gold standard guarantee that the financial statements give a true and fair view of the state of the company's affairs. So, what's the big takeaway? I want you to remember these tight timelines, these exact thresholds, and those specific form numbers. Because in the high-stakes world of corporate auditing, knowing exactly when and how to sound the alarm is all about fulfilling your fundamental statutory duties. The clock starts ticking the very second you uncover a discrepancy. The only question is, the clock is ticking, the formatting is strict, and the fines are massive. Are you ready to act without hesitation the next time you spot a financial red flag?
The company auditor. We rely on these professionals to be the objective, independent watchdogs of a company's financial health. But what happens when the watchdog fails? What happens when they miss a critical error or worse, deliberately look the other way? Well, under corporate law, the stakes for auditor accountability are incredibly high, and the cost of failing that duty can be absolutely catastrophic. Let's look at exactly how the law bites back.
Here is our roadmap for this explainer. 1. The baseline of auditor duty. 2. Civil liabilities explained. 3. Criminal liability regarding the prospectus. 4. The actual cost of non-compliance. 5. Fraud and false evidence. And finally, number 6, contractual and other liabilities.
Part 1. The baseline, auditor's duty. Moving right along to Part 2. Civil liabilities explained.
So, as we establish the baseline duties specified by the Companies Act of 2013, we see that failing them holds an auditor legally liable, whether that's to their appointing authorities or directly to the government. When we talk about civil liability specifically, we're primarily talking about financial compensation. A really key term here is misfeasance. Under Section 340 of the Act, misfeasance essentially means a breach of trust or negligence in how an auditor performs their duties. Stripping away the heavy legal jargon for a second, this charge typically drops at a very specific high-stress moment, the liquidation of a company. If a company is going under and it's discovered that the auditor misapplied money, retained company property, or was just generally guilty of a breach of trust, they will be charged with misfeasance to recover those losses.
Now, liability doesn't just happen in a vacuum. Take the company prospectus, for example, the document used to invite the public to buy securities. If an auditor authorizes a statement in a prospectus that turns out to be misleading, that exact same document can trigger 2 entirely different sections of the law. On the civil side, under Section 35, the auditor is personally held liable to compensate anyone who subscribed to the securities and lost money based on that bad information. But simultaneously, Section 34 triggers criminal liability for authorizing an untrue statement.
Which brings us right to Part 3, criminal liability, the prospectus.
Now, what's really fascinating here is how we transition from simply paying out damages to facing the full punitive force of the state. Section 447 is the heavyweight provision for fraud, and the punishment scales mathematically. If the fraud hits an amount of at least 10 lakh rupees, or 1% of the company's turnover, whichever is lower, the baseline prison sentence is 6 months to 10 years, plus a fine of up to 3 times the fraud amount.
But notice that top scenario. If that major fraud involves public interest, the minimum prison time instantly jumps from 6 months to a non-negotiable 3 years. And even for smaller frauds under that threshold, an auditor is still looking at up to 5 years in prison or a 50 lakh rupee fine.
10 years. Just let that number sink in for a second. That is the maximum prison sentence for major corporate fraud under Section 447. This visual shock value is entirely intentional by the lawmakers. It anchors the absolute severity of the law. An auditor isn't just risking their career. They are literally risking a decade of their life if they authorize misleading statements that defraud the public.
All right, part 4, the cost of non-compliance. So what if an auditor just ignores the basic rules? Section 147 spells out the cost of non-compliance with fundamental statutory provisions, specifically Sections 139, 144, and 145. And the law explicitly draws a line between a basic failure to comply and deliberate willful deception. If an auditor simply contravenes the rules, they face a fine between 25,000 and 5 lakh rupees, or 4 times their remuneration, whichever is less. But if it's proven the auditor broke the rules knowingly or willfully with the intent to deceive the company, its shareholders, creditors, or tax authorities, the punishment explodes. They now face up to a year in prison, and the maximum fine jumps to 25 lakh rupees, or 8 times their remuneration. Intent changes absolutely everything.
And honestly, this perfectly illustrates how punishments don't just stop at a single fine. They compound, devastating both the individual auditor and their entire firm. First off, a convicted auditor has to refund their entire fee back to the company. Then, they have to pay out of pocket for any damages caused by their misleading audit report. Crucially, if the audit was done by a firm and partners acted fraudulently, the firm itself and the concerned partners are jointly and severally liable for the fines. However, when it comes to actual prison time, criminal liability beyond fines, only the specific partners directly involved in the fraud will serve the sentence.
Part 5, fraud and false evidence.
Let's walk through the ultimate consequences here. As we've seen, whether an auditor misapplies money during liquidation or deliberately includes false, misleading statements in critical reports, the state brings the hammer down. Engaging in intentional deception triggers those massive Section 447 penalties we discussed, ensuring that a willful betrayal of trust is met with severe prison time and compounding fines. This is the area where the law shows absolutely zero leniency.
But here is a question for you. What if an auditor tries to claim ignorance? Can they use a lack of direct knowledge as a shield to get off the hook if they miss something major?
Let's look at Part 6, Contractual and Other Liabilities.
The underlying legal philosophy here remains the same: complete accountability. The law legally expects an auditor to conduct a thorough, honest examination, as laid out in provisions like Sections 34, 35, and 147. If you authorize misleading statements or omit material facts, whether it's to the public, the shareholders, or the tax authorities, you cannot use ignorance or incomplete work as a shield. You are liable for the damage caused. Full stop. Ultimately, the whole system only works if the financial data is reliable. And it's only reliable if the auditor is held to an incredibly high, uncompromising standard. From civil damages to massive fines, all the way to a decade in prison for deliberate fraud. When the watchdogs fail, the law bites back hard. Which leaves us with the critical thought to consider about the structures of corporate governance around us. What safeguards does your auditor have in place?
So, it brings up a really fascinating question. What actually happens when the folks tasked with ensuring corporate honesty step out of line, or worse, commit fraud themselves? Who holds them accountable, and exactly how harsh are the penalties? Well, as we're about to see, the rules governing auditors are definitely not just suggestions. They are incredibly strict, deeply detailed, and quite frankly, pretty punishing. Okay, let's dive right into this. Here is our roadmap for today. First, we'll establish the high stakes. Then, we're going to break down auditor accountability into 3 distinct pillars: statutory liabilities, liabilities under other acts, and contractual liabilities. Finally, we'll wrap it all up with the bottom line. Number 1. The high stakes, and why auditor accountability matters. Moving right along to our first pillar, statutory liabilities.
Now, what's really interesting about these rules laid out directly in the Companies Act is how incredibly fast the punishments escalate. Take Section 217, for instance. If an auditor just flat out refuses without a reasonable cause to produce a document for an inspector or refuses to answer their questions, they're looking at up to 6 months in prison and a fine between 25,000 and 1 lakh rupees. Oh, and an extra 2,000 rupees for literally every single day they keep refusing. But then, Escalate that to Section 336. If an auditor is caught doing fraudulent activities while a company is winding up, boom, that punishment skyrockets to somewhere between 3 and 5 years behind bars, plus fines hitting up to 3 lakh rupees.
And you know, statutory law gets even heavier when we start talking about deliberate deception. Look at Section 448. If an auditor deliberately makes a false statement in a report or intentionally leaves out a crucial material fact, they get hit under Section 447, which is the section that handles severe corporate fraud. But wait, under Section 449, if they intentionally give false evidence under oath, say during a company winding up, they are facing a strict 3 to 7 years in prison. And the fine for that? It's absolutely massive.
That fine can reach up to 10 lakh rupees, 1 million rupees. Just take a second to let that shocking maximum penalty for giving false evidence under oath sink in. It really showcases the sheer gravity of statutory law. The entire legal and financial system relies completely on the sworn honesty of these experts, and that number right there proves exactly what it costs to betray that trust.
All right, let's shift gears to Pillar 2, liabilities under other acts.
Because here's the thing. An auditor operates in a highly complex ecosystem. Their legal tripwires extend way beyond just the Companies Act. We're talking about the Income Tax Act, where abetting someone to make a false income declaration is a flat-out crime, the Chartered Accountants Act, where professional misconduct is strictly monitored, the Life Insurance Act, which dictates that false statements and returns lead straight to imprisonment or fines, and the Banking Regulation Act, which ensures any willful lie or material omission on a bank's balance sheet holds the auditor directly liable.
So what's the common thread across all these different regulations? It's beautifully simple, but highly punitive. Knowing a statement is false or willfully hiding material facts triggers massive liability across the board. Whether it's helping someone fake a tax return or willfully omitting a key statement for a bank, deliberate deception is punished universally across every single sector. There is literally nowhere to hide.
Which brings us to our third pillar, contractual liabilities.
So the crucial point here is how the Indian Contract Act of 1872 comes into play. It's all about the direct agreement between the auditor and the client. If you have a written contract, great. The scope of your audit work is strictly locked into those exact agreed-upon terms. If you breach them, you're liable. But what if there's no written contract? Well, you might think you're off the hook, but actually, the law expects the auditor to conduct a complete, full-scale audit. If they decide to just do a partial audit and an error or fraud pops up later, the auditor is entirely on the hook for it. Essentially, having no contract forces the auditor to do maximum work, just to protect themselves.
And beyond just the scope of the work, there is the sacred duty of confidentiality. Auditors get access to a company's deepest, darkest, most guarded secrets. Leaking any of that confidential information to a third party isn't just a bad look, it is a direct breach of their contractual liability and opens them up to severe legal action.
And this brilliantly illustrates that this isn't some new corporate trend. Look at the landmark case of Wild and Others versus Cape and Dalgish, decided way back in 1897. It established a rock-solid rule. If a client loses money because the auditor didn't comply with their contract, the auditor has to compensate the client for that loss out of their own pocket. Well over a century later, this precedent remains the absolute foundation of an auditor's contractual liability.
Let's move to our final section and see how all of this builds together into the bottom line.
We've traversed a pretty intimidating landscape today, haven't we? From the massive fines and guaranteed jail times under the Companies Act, to those strict industry-specific regulations, all the way down to a century of contract law. We rely on auditors to keep the entire corporate world honest. But with the constant threat of prison, 10 lakh rupee fines, and relentless contractual liabilities hanging over their heads, who really has the courage to audit the auditors? The cost of a mistake isn't just a lost client. It's potentially the loss of their freedom. Thank you so much for joining me on this explainer. Keep asking those big questions and keep exploring the hidden frameworks that hold our business world together.